Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing StoneCo stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. StoneCo provides merchant services to Brazilian businesses. It is like Square, but in Brazil. They also provide loans to some of those businesses. If a company wants to sell items in their store or online, they may contact StoneCo and use their software to do so. The company is headquartered in the Cayman Islands and was founded in 2000. The ticker trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, London Stock Exchange, and Sao Paulo Stock Exchange. Let's get started with the model. This is a mid-cap company, 4.3 billion market cap. They're trading at $14 a share, and they have 309 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had their first positive free cash flow in 2021 at close to $500 million. Net income is a profit or loss on the income statement. It's revenue minus expenses. And that's positive each year, except in 2021, it's negative. Revenue is a sales for the company, and that almost exactly triples from 2018 to 2021. This is the company's income statement. All their financials are reported in reais, but I converted these numbers to US dollars on my Excel spreadsheet. The top line is the revenue, the sales, and they generated 4.6 billion of reais in 2021. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. All the expenses to maintain their software are part of cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that more than doubled from 2018 to 2021. Below that is their operating expenses. Examples of operating expenses are marketing and payroll for support functions. Gross profit minus operating expenses gives you your operating income, and that is positive every year. It was highest in 2020 at 1.5 billion reais. They spent 1.3 billion of interest on their debt, which is a lot higher than prior years. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. That's why they had negative net income in 2021, due to this large negative in other income and expenses. It's almost impossible to value a company like a bank looking at the income statement. They're not a bank, but they do lend money, and there's lots of mark-to-market adjustments, and that could really skew some of the numbers on the income statement. This is the company's income statement directly from their annual report, and this gives us a little more info than Yahoo Finance. Every time one of their customers uses this company's software to sell a product, that's like a credit card transaction, and this company receives a portion of that, a small fee. That was 1.6 billion in 2021, which is about double 2019's number. Their subscription and equipment rental is 1.1 billion, and that's gone up a ton since 2019. Their customers are Brazilian businesses, and some of those businesses pay this company a monthly subscription. And those businesses are able to use this company's software also to get other additional services. You know those POS systems that you scan your credit card? This company rents those out to those businesses. That's what equipment rental is. Their largest revenue number is financial income, 1.9 billion, and $250 million from other. Their financial income consists of these three items. Interest income on the loans, that's probably the bulk of it. And other income is the interest they receive on short-term investments. When a customer buys an item from a Brazilian business, this company gets the money like a bank, takes their fee, and transfers the rest of the money to the business. But sometimes they sit on that money for 1 or 2 days and earn some interest. The cost of services is 1.7 billion. This includes payroll, depreciation and amortization, 800 million of admin expenses, 1 billion of marketing, 1.3 billion of financial expenses. This is the interest they pay in their debt, 1.3 billion of mark-to-market of equity securities. This acronym stands for fair value through profit or loss. This mark-to-market adjustment was not in prior years. That's why they had a profit in prior years, but a loss in 2021. This is a non-cash item, so it gets reversed out on the statement of cash flows. They pass through a loss of 10 million reais on some of their investments, So they did have negative net income in 2021, but a statement of cash flows is a better indicator than the income statement, especially for a company like this. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or generates from its operational business. Their operating cash flow has improved a lot, from negative 2.4 billion to positive 3.6 billion. Then you have CapEx, investments in property, plant, and equipment. A lot of their CapEx is investment in their software. Operating cash flow minus CapEx gives you your free cash flow. That was negative in prior years. Now it's a big positive. They did add a lot of debt in 2018 and 2019. They paid down a little more debt than they issued in 2020, and they added about 2 billion of debt in 2021. But they bought back about 1 billion of stock that year. Their investing cash flow is negative 6 billion in 2020, and they only spent $500 million in CapEx because they did lots of acquisitions in 2020. They also did some in 2021. This is their operating cash flow section from their annual report. And the way you calculate operating cash flow, you start with your net income or net loss, then you add or subtract the non-cash items on the income statement, adjust for changes in working capital. So even though they reported a net loss of 1.4 billion, they actually generated 3.6 billion of cash flow. We have to add back that 2.6 billion fair value adjustment. They had a cash inflow of 4.3 billion from accounts payable to clients. Accounts payable to clients is more of a timing thing. If I was in Brazil and bought 100 reais of groceries, and the supermarket used this company as their merchant, then this company would receive that 100, maybe take 2 or 3 reais as a fee, and then after a day or two, send the 97 or 98 reais to the supermarket. So it's just a timing thing of money. They're not in debt to their clients. They just need to send the money to them. But at any given time, they're going to have tons of money sitting in their account. That's how banks and a lot of financial institutions make money, on the float, on the cash that's sitting in their account. That transaction at the supermarket was about $20. 100 reais is about $20. And how much money can you make on $20 investing in an overnight investment? You would get maybe a 1% annual rate. So it's 0.01 divided by 365. But when you have millions of transactions every day, it does add up. I like to track a company's revenue, that's the blue line since 2016, and operating cash flow, that's the orange line since 2016. And their revenue is going up nicely each year. And their operating cash flow was negative for a while, and they had their biggest positive in 2021. The forecast is for their revenue to continue rising. The only reason their operating cash flow was so high was that 4 billion reais in payables. If you remove that, it would be pretty much flat. But as long as it's positive, it's a good thing. If a company never obtains positive operating cash flow, it will go bankrupt. It can't survive. A company can have negative free cash flow, not every year, but for many years they can. But if a company continuously has negative operating cash flow, it just can't survive. This is the company's investing and financing cash flows. They spent over 1 billion in PP&E. Each year they acquire intangibles. A company cannot buy intangible assets. They're part of a business combination or business acquisition. And they spent 1/4 billion in acquisitions in 2020, 4.7 billion in 2021. In 2021, they also bought 2.5 billion of equity securities. These are investments in other companies. Those other companies may be public companies or private companies. They have a lot going on in their financing section. They added 11.7 billion of debt. They paid down 7.3 billion of debt. The FIDC is a popular tool for Brazilian banks and other companies to get funding. They paid back 2.8 billion on that, and they added 584 million. They bought back 988 million of stock. So in their financing section, they had a cash inflow of 1.4 billion. Last year was a cash inflow of 7.2 billion. That's mainly from the 8 billion of stock they issued. This is the equity section on their 12/31 balance sheet. They have 13.5 billion of equity. They raised 14.5 billion from selling their business, and they profited 96 million from running their business. Retained earnings is the sum of all their prior net incomes, and they bought back over 1 billion of common stock. Let's look at their capital structure. They have 2.8 billion of equity, 1.8 billion of debt. They're 62% equity, 38% debt. And they could pay off all the debt with the cash on their balance sheet and still have 99 million of cash left over. Their equity balance has gone up a lot since 2016. That's the best way to be a viable business if your equity balance increases a lot more than your debt balance. And they always keep a lot of cash on their balance sheet. They usually have enough cash to pay down all their debt if they wanted to. I gave them the lowest whack on Finbox, 11.8%, because it is a Brazilian company, and Brazilian companies are a lot higher credit risk than a US company or British company or Canadian company. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $14 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $12 billion. We divide that by 309 million shares. And we get a calculated stock price of $39. They're trading at $14, so they're trading at a 64% discount. It's a strong buy according to the model. Their revenue is projected to increase 28%, so I grew their revenue 28% for the next 4 years. That's how I got their future revenue estimates. They converted 50% of their revenue into free cash flow in 2021. So I multiplied their future revenue estimates by 50%. That's how I got their future free cash flows. The website Simply Wall Street is a lot higher than me. They're at $79 a share. They're saying it's 82% undervalued. 8 analysts priced this stock and the average price target is 20. The low is 10, the high is 39. This is where the stock has been trading since it IPO'd. It looks like it started trading at about $31. And then after a year, you'd be up 10%. After a year and a half, you'd be down about 35%. But you could have tripled your money if you sold at the peak. But if you're still holding on, you'd be down from the original IPO price. Their margins were amazing in the fourth quarter of 2020. They were still pretty good in the first quarter of 2021. And that's when the stock peaked in the first quarter. But in the second quarter of 2021, they had negative net income. And then people got really scared and started selling off their stock. And that's when the stock started coming down. Their margins were positive in the third quarter and fourth quarter, but you can see their margins were a lot worse than these points. So I think that's a big reason for all the sell-off and why the stock price has come down so much. But the company did say in a press release they try to scale and grow too much. And they did admit that was a little too aggressive and they're going to try to take a more conservative approach to growth. So you can see 2020 was a great year. They had 29% margin. 2021 was terrible. They report positive net income in 2021, even though the income statement said negative, because adjusted net income removes a lot of the non-cash items. If you invested in this stock and the S&P 500, you'd be up 69% with the S&P 500, down 56% for this stock. At one point, you would have been up almost 200% with this stock. Every quarter, more and more businesses are using their platform. They have over 1.7 million customers using their software. And their banking clients are also increasing. It was only 42,000 in the first quarter of 2020. Now it's nearly 500,000. There is risk though when they lend out money. The customer may never pay back their loan. They have a really high beta, 2.39, so the stock is volatile. It moves more than 2 times the market. It's gone down 78% in the past 52 weeks, while the S&P is up 14%. 52-week low is 8, the high is 71. And the stock is trading between its 50-day and 200-day moving average. Almost 18 million shares have been traded each day the past 10 trading days. 73% of the shares are held by institutions. It has a fairly high short percentage. 9.5% of the shares are shorted. They're adding employees each year. They employ over 7,000 people. If you invested $10,000 into this company when it started trading, you would have been really happy at one point and then really unhappy now. 58% of the company is held by institutions, 22% by the general public, 8% by venture capital and private equity firms, 7% by private companies, 3.5% by public companies, and 1.5% by insiders. Capital Research is the biggest shareholder at 12%, 37 million shares, valued at $500 million reais. Then Madrone Capital Partners, 7% by HR Holdings. The people who own HR Holdings are the people who started this company. They control a majority of the voting rights. Warren Buffett's Berkshire Hathaway owns 3.5%, then Nikko Asset Management. Let's look at their financial ratios. We can't look at the PE since they have negative net income, They have a price to sales of 4.5 and a price to book of 1.5. Let's look at their non-current assets. 59 million of receivables. This is how much money is owed to them. 432 million of deferred tax assets. This should help decrease their taxes in the future. 214 million of prepaid expenses. This is when a company makes an advance payment for a product or service they're going to receive in the future. 1.2 billion of long-term investments. These may be investments in other companies. 1.6 billion of property and equipment, and 8.4 billion of intangibles. Here's a breakdown of their intangibles. 5.7 billion of goodwill, 1.6 billion of customer relationships. When they acquire another company, they need to value that customer base, and they carry that as an asset on their balance sheet and then amortize that dollar amount over its useful life. They have trademarks and patents, software in progress, right of use assets. The gross amount is 8.7 billion. The amortization is 342 million. So the net amount is 8.4 billion. Let's look at their non-current liabilities. 3.6 billion of loans and financing. They owe 930 million to the FIDC. This is what that acronym stands for. 617 million of deferred tax liabilities. This should increase their taxes in the future. They posted 181 million of contingencies. These are dollar amounts set aside for estimated future losses. 33 million of Social Security liabilities and 350 million of other. They have a good current ratio and quick ratio, both 1.3. Let's look at their current assets. 4.5 billion of cash, 2 billion of short-term investments. These are investments in low interest paying, safe and liquid investments. They have 2.3 billion of financial assets from banking solutions. I think financial assets from banking solutions are some of the loans they provided. Then 19.3 billion of accounts receivables from credit issuers. And this is carried on the balance sheet as fair value through other comprehensive income. This is mainly the timing of money when someone buys something from Brazilian business. 886 million of trade accounts receivables. This is what's owed to them. It looks like they have a tax credit of 231 million. And then they have prepaid expenses, derivatives, and other. Let's look at their current liabilities. 2.2 billion of deposits from customers. So it looks like customers can put money into a savings account or checking account and earn a little interest. And StoneCo uses those funds to lend out to others. Maybe they'll loan the money for 10% and pay 0.5% to the customers who are putting money into their checking or savings account. They owe 16 billion to their clients. Once again, this is the timing of the transactions. They owe 373 million to other businesses. They have 2.6 billion of loans and financing. When they loan money to a business, it's reported as an asset and liability on a balance sheet. They owe 177 million of taxes to the government and only 23 million of derivatives and 145 million of other. They generated 485 million of free cash flow in 2021, and they have 1.5 billion of working capital. So they have about 2 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. There are 148 companies in the same industry as StoneCo, and StoneCo ranks 60th in market cap at 4.3 billion. The average is 25 billion. They're less leveraged than the average company. They have a much better price to book. We can't look at the PE. They have a really good price to free cash flow and a good price to sales. A lot better than average. Their 3-year annual growth rate is 45%, much better than average. So to summarize, I have them trading at a 64% discount. And this looks like a great opportunity to buy this stock because it's pretty much trading at its all-time low. It's trading lower than when it IPO'd. And the company may have had some hiccups in 2021. As long as you feel comfortable with their business model and their management, you could definitely 2 or 3x your money this year. That's of course if they start reporting better margins than they have been reporting the past 2 or 3 quarters. I rank their free cash flows and revenue 7 out of 10 and their ratios 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.